Hi, everyone. Welcome back to Be Rich. Welcome to the podcast. I thought today we'll talk about our billionaire investor, Seth Klarman. And he had come out in an article and a news report about what he had said a month ago, which talks about the persistence of an everything bubble. And that the future is not looking very good, and that we're going to have some more banking catastrophes that may be coming. And the bubble which he's talking about is from the pandemic. This bubble, it was induced in the pandemic, where asset prices have been going up, and things are not looking good because of this bubble, which is continuing to grow since then. Then he specifically talks about the banking sector. He highlighted the potential of coming more banking problems, and the collapse of the Silicon Valley Bank is just the beginning, he says. And there's a possible sign that more banking disasters are there ahead. So, what does it mean by this everything bubble? He says the everything bubble is a situation where it's initiated as it starts as a credit bubble, and he had put says these super low, sometimes zero interest rates, which we have been having across the world, has given access to everyone to cheap capital, and this cheap capital has gone into speculation. Is what people everyone hoped was when the government's hoped when this cheap capital was given, that it'll be going into businesses, in turn into investments, and that leading into more jobs and more security and greater economic growth. But he says that didn't happen. All this money was taken into gambling, which is what speculative means. These speculative activities were such as startups were in a craze, then SPACs and meme stocks and cryptocurrencies. These were all fueled by this cheap currency which was coming in. This created this everything bubble, where this bubble in multiple asset classes has been growing. So, what does he say about the current market status? He says, despite the bubble somewhat collapsing last year, the stock market has rebounded, and the S&P 500 has rallied by 17%, and the Nasdaq Composite has gone up by 35% this year, which is again not good. And his caution is expressed. His biggest concern is in the banking sector. With a limited probability over the last decades, lenders might be have taken higher bets, similar to Silicon Valley Bank, and neglected to hedge their positions, meaning they have not taken insurance against these risky bets these banks have made. So these unhedged bets, which some of these banks are sitting on, some of it is not very clear which banks are sitting on what bets, is going to lead into bigger problems, as the famous saying goes, as tide is going out, who's swimming without their clothes on is going to become very apparent. And he says, what is going to happen once this bubble bursts? What's going to be left? He says it's very hard to see what is going to happen, because it's all very foggy and very murky right now, and we really don't know where the bodies are buried, and we have no clarity in this. So what is going to happen? So a lot of people are saying, can the governments do anything? Can the governments bail out these banks for these reckless behavior? Even there, he says it's not a good thing to expect the government to keep guaranteeing everything, and guaranteeing all deposits, guaranteeing all banks across the board, and bailing everything out. He says that is actually reckless behavior, and he says what will happen is we'll become complacent, and this will lead to bigger and larger bubbles in the future, leading to a bigger economic downturn. He says it's better to reprimand bad behavior by banks and lenders, and not keep bailing everybody out across the board. And then he gives, of course, some historical context he talks about, when these market in the past have shown this kind of uncontrolled bailouts, and these uncontrolled monies being poured into market has led to similar problems in the past. So he says we should learn from our past and not keep repeating the same mistakes over and over again. So a lot of you who do not know Seth Klarman, who is he? Well, he's the guy is a very famous investor. He's called the next Warren Buffett by a lot of people. He's been recognized even by Warren Buffett. Has said Seth has the uncanny ability of recognizing undervalued assets. He's a CEO of a group called the Baupost Group, and he has written a famous book. It's called Margin of Safety: Risk Averse Value Investing Strategies for a Thoughtful Investor. It's a book which is highly sought after, because it only ran in one edition, and after it's sold out, he has not reprinted it. So, in the halos of value investing, copies of this book is always seen as something as a collectible, and a lot of people have always been trying to buy it. And you can see it in eBay and other auction places when it does come up for auction that it sells for some crazy amount of money. So, what does he talk about in the book? He talks about value in investing philosophy. Klarman emphasizes on the importance of value investing, which involves buying securities at significantly below their intrinsic value. Then he says that you have a margin of safety, which will be a buffer, and that buffer will protect your investment from any adversity that may happen. And he also refers to Mr. Market, drawing the inspiration from Benjamin Graham, where he describes the market to participate, Mr. Market, as a manic depressive business partner, and who goes around allowing you to buy in things daily. But he says, as an investor, you should not be influenced by someone who's a manic depressive because he suffers massive mood swings through the day. But you should focus on the underlying value of the business and not be influenced by the market, because he says markets can swing for no apparent reason at all. And he says you should do due diligence, the importance of going through research and understanding every investment opportunity before putting any of your money or capital behind it. Please do not follow the crowd blindly. This could lead to significant losses because you don't see what is happening. You can't avoid the pitfalls if you do this. uh, Most of the common mistakes people make, he says, is over reliance in financial predictions and short term focus and herd mentality. These three things are the main reasons for people to fail in investing: is over reliance on financial predictions. That means you try to forecast what's going to happen. As me and Case have talked about, astrology, people use astrology even to that extreme to see what's going to happen in the market. Then the other is having a short term focus, trying to look for short term gratification and not focusing on long term gains. And the last one, which he talks about, is herd mentality, which is following the crowd. Herd mentality is going to the slaughterhouse where you see animals being herded in to the slaughterhouse without realizing they're going to their doom. He says the same thing happens to most investors when they don't pay attention to what's happening. Investment opportunities, he covers various avenues in the book as investment opportunities, which are distressed securities, corporate restructuring, and liquidations, saying these are great opportunities which come in the market. When they do come in, there's something worthwhile looking into as an investment option. And he's not synonymous with volatility. He says true investment risk is a possibility of permanent loss of capital, but in short-term price fluctuations, should not worry about. Meaning that yes, there is possibilities market can stagnate or markets can go down, but when in the long run, if you look at it, you should not worry about it. That spoken about, someone did yesterday say, what happens if we become like Japan, where the Nikkei stagnated for a long period of time? Yes, things can turn downwards, things can go bad. Yes, this kind of stagnation is happening in our real estate market. Why do we need to talk about the stock market in Japan? The Indian real estate market has been stagnating for a long period of time, since 2010, 2012. It's not gone anywhere, our real estate market. It can happen. That's why we avoid those investments. That's why me and Anand keep on saying investment real estate as an investment class is not a great class right now, because the returns are not as good as stock market. So if the Indian stock market becomes like the Japanese stock market, not offering returns in the foreseeable future, then me and Anand will tell you guys not to invest in the stock market. Me and Anand are not married to the stock market or married to sipping. It is that currently, out of all the asset classes available, this is what's working the best for us as an investor. If something else offers more better returns and more security, of course, we will switch over and start recommending that. As an investor, where we are putting our money is what we are talking about. Of course, we're not SEBI registered investor guides or gurus. So do keep that in mind. Whatever we say here is just our opinion. We're not asking you to do something. Please do your due diligence and talk to your financial advisors, and talk to your SEBI representatives before you decide to move any of your cash. Getting back to the book, he talks about the role of cash. In Klarman's view, he says it's important to have the potentiality of keeping cash So you can take advantage of opportunities when they arise, especially in volatile markets, which is what we also spoke about yesterday in my podcast. That holding on to a certain percentage, depending on your age and your requirement, that to keep 10% to 20% of your sipping amount in a separate account as your war chest. So when these huge turns in the market do appear in volatile markets, you can deploy these capitals which you have saved and kept aside for investing, and take advantage of wonderful pricing opportunities that may arise. We spoke about Indian hotels during the Mumbai blast, which happened. Then we spoke about during the pandemic crash of the ITC shares. Then we spoke about IndusInd Bank, which corrected hugely, which a lot of people could have invested into. So as long as you know your fundamentals and you have a lot of cash sitting on a lot of cash, like Warren Buffett or anybody, you can invest into these opportunities which appear. The next thing he talks about in the book is something known as a contrarian view. Contrarian view is, to be a successful investor, you're required to look at the opposite of the herd. The famous song in the Disney movie, Lion King, when Simba goes and makes friends with the two outcasts of society, he says, "When the world turns your back, you turn your back on the world." It's pretty much like that. Is to have the opposite view of the herd. He says it will be uncomfortable to think opposing views. If everybody's saying the market is great, it's a bull market, he says you should look at it the other way around and say maybe it is not a bull market, maybe it's not so great. If everybody is saying the market is terrible, everything is horrible, then we should probably look at it and say maybe it's not so terrible and maybe there are opportunities. So he says that this kind of mindset is essential to achieve better than average results. It's called a contrarian view of thinking. And most and the last important point which he talks about in the book is called the importance of patience. He says, as an investor, we should learn to be patient and wait for the right opportunities rather than being driven by the need to always be investing. I've seen this happen in our channels where a lot of our viewers are constantly saying, where should we invest? Where should we invest? Where should we invest? Should I buy this? Should I buy this? Should I buy this? It should not be your mindset. Your mindset should be, okay, you're giving me all this information. Okay, let me listen to all this information. Let me ponder and think about it. Then make a calculated investment plan according to my needs and my requirement. Your investment plan and things should not be based on what I'm saying or what Anand is saying. It should be based on what you have come to understand. That is why it's important to be patient and think. Opportunities are always there in any market, but it's up to you as an investor to patiently sit and weed through the facts and get to the truth of the matter and invest wisely. This is what he talks about in his book, Margin of Safety. Like I said, it did a very limited run print and it's not widely available. That's why it's a collector item. If you do land your hand on it, do think of that itself as an investment. That being said, I hope you enjoyed the podcast today where we talked about Seth Klarman's feature, which was a month ago, and his book, Margin of Safety. If you do manage to get your hands on a PDF version or an online version, do read it. It's a wonderful read. And I do highly recommend it to everybody who manages to get their hands on it. Thank you for joining me on Be Rich today. Do subscribe to this podcast and my channel and turn on the bell notification so me, Anand, and my team can give you more information as we find them. Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.